Christmas season is at our door, and while many of you might already be shopping to find the perfect gifts for your parents and your kids, today you'll find what are the best gifts for you in the form of stocks for the new year. In this video, you will discover what are the 3 best stocks that I'm keeping a close eye on for December 2022. But to pick those different companies, I've used many different criterias. First, I've looked at what is the business model of the company, so how are they making their money and who are their different customers, and after, I've taken a look at what is their current momentum. And finally, as always, I've made a quick fundamental analysis on each and every single one of these companies to see if it is sustainable on the long term. Now, let's take a look at my pick number 1. The first company that I've included on my list is the American real estate company Prologis with the ticker PLD. This real estate investment trust company located in San Francisco is buying and operating many different logistic operating facilities. And with close to 1 billion of square feet of real estate properties all around the world in more than 19 different countries, it is currently the largest industrial real estate investment trust companies in the entire world. All of this while keeping an incredible market cap of over $100 billion at the moment. And with over 2,000 different employees all around the world, they are trying to find and fix the problems of the labor shortage. All of this while working in different high-growing markets in Europe, North America, and Asia. This is giving them a strategic and a leader position in that field that will be super important in the upcoming years, especially with the growth of companies like Amazon, which is already one of their customers, along UPS, FedEx, and La Poste. But what makes this company even more interesting in those times of high inflation and a potential recession is that this is considered as an edge against inflation because of the capacity of the real estate companies in general to increase their revenues even throughout an inflationary economy. All of this knowing that those kind of companies in the real estate sector, which are known as the real estate investment trust, must distribute about 90% of their total net income, which are obviously distributed to the different shareholders in the form of dividends. This is a great company for the different dividend investors that are looking for a great dividend income from a certain company, but that are also looking to protect themselves against a future recession. And a great news is that this company has also massively beaten what were the prediction of the analysts for the past earnings. Unfortunately, since the acquisition of Duke Corporation for about $23 billion at the beginning of September, the values of their shares have been plunging. Adding that to the fact that Amazon and FedEx were closing many different facilities, this has been scaring many different investors. However, knowing that the average occupancy rate of this kind of company is about 97% in their total real estate properties, well, this shouldn't be a too big problem for them. But since that point, and since the mid-October, we've seen that the momentum of this company has regained some strength. But now, is this stock worth your money in terms of valuation? As I told you earlier, Prologis currently has a market capitalization of over $107 billion with a super low price to earning ratio of only about 21, which is quite lower compared to the average of the real estate investment trust industry, meaning that this stock on that side would be undervalued at the moment. This company also has an insanely good profit and operating margin, as well as some great return on equity of about 11%. And as you can see, with their $5.91 billion of revenue over the last 12 months, in the last quarter of 2022, they have been able to increase their revenue of about 44% year to year, and they have been also able to increase their quarterly earnings of about 40%. Unfortunately, as being a real estate company, this company doesn't have a lot of cash compared to what is its debt. However, on 5 years, you can see that the beta of this company, meaning that the risk of this company is a little bit less risky compared to the average market. But on the last year, we can see that it has been varying of about less 26% compared to about less 13% for the overall market. But what is one of the most important thing about this company is that they are giving a close to 3% of dividend yield per year to their different shareholders with an excellent payout ratio of only 55%, meaning that they are not using too much of their net income to pay the dividends to their different shareholders. And finally, as you can see, they have been able to increase their total revenue over the last 3 years, which has led them also to increase their total earnings before interest and taxes. And we can also see that their operating cash flow have been also massively massively increasing over the last 3 years, which are giving them some great free cash flow growth over that same period. My second stock is a well-known pharmaceutical stock which is known as Johnson & Johnson with the ticker G&G. This American multinational, created in 1886, is focusing in the creation of different medical devices, consumer packaged goods, and pharmaceuticals. Obviously, their main mission is to keep people in good health at every age and at every stage of their life. But they also want to give access to healthcare to a massive and a vast majority of people. Indeed, with their massive 140,000 different employees all around the world, they are trying to change the trajectory of health since more than 135 years now. And their international impact has helped them to generate over $93 billion of revenue last year. And this makes it the highest paid drug company in the entire world. As you can understand, the biggest part of their revenue are coming from the different drug prescription and also the different medical devices. However, they also hold many different companies and products that are well known everywhere. For example, they own Aveeno, Clean and Clear, Neutrogena, Benadryl, Benylin, Motrin, Tylenol, Band-Aid, Listerine, and Polysporin. As you can see, this company has many different star products that have helped millions of people during the last couple of years. But this company doesn't only have some great products, it also is one of the best companies to keep an eye on at the moment because of the current trend on the market. As many of you might already know, we are currently in a technical recession, meaning that the economic growth will probably be slow in the next couple of months. And if there's one sector to keep an eye on at the moment, it is the healthcare sector. In fact, even throughout crisis time and recession times, people will keep being sick, meaning that there will be a massive need on that side. And so the healthcare sector is a great sector to invest in during the recession times, especially right now when we know that we are in a recession, because it is an essential services. So it's great to be able to own a company that is performing well in the recessionary environment, but it could also offer some low volatility to your portfolio, meaning that it could reduce the risk of your overall portfolio. And this can be seen by the great variation of the price of the share since the beginning of the year. In fact, it is one of the rare stocks that since the beginning of the year has been able to have some positive momentum. And this has been translated in some excellent earnings over the last 4 quarters. Add to this, you will receive a juicy dividend when you'll be investing in that particular stock. But now, let's see what the valuation measures are telling about this company. This company currently worth a massive $463 billion with a super low price to earning ratio of only about 24, which is quite lower compared to the average of the healthcare industry, meaning that this stock on that side would also be undervalued. Johnson & Johnson also has some great profit, operating margin, and a great return on equity of close to 26%, and it has a great revenue over the last 12 months of about $96 billion, and for the last quarter of 2022 it represents an increase of close to 2% compared to the same period last year, and in that same quarter they have also been able to increase of about 20% their quarterly earnings. Johnson & Johnson pretty much has as much cash as what is their current debt. And as I told you, this company on the 5-year period has way less risk compared to the average market with a beta of only about 0.57, and we can see that on 52 week it has been in the positive of about 13% compared to less 13% for the average market. In terms of its dividends, it's currently giving about 2.55% of dividend per year with a great payout ratio of only about 61%. Over the last 3 years, we can also see an increase in their total revenue, which has led to an increase as well in their net income. But over that same period, we can see that their cash flow from the different operating activities have been pretty much the same, which obviously means that their free cash flow are also staying about the same. And finally, for my last pick, I've went in a sector that is pretty essential for most people and picked the company Costco with the ticker COST. Costco is currently considered as the 3rd largest retail company in the entire world, which is mainly focusing in the operation as a chain of membership, only big box retail stores. Basically, the customers of Costco will pay an annual membership to buy different products at Costco. On their part, they have and they can receive some very large quantities of different objects such as food, clothes, etc., for a certain discount price. So you can receive some interesting products but at a super cheap price. But in fact, how is Costco able to give those great advantages to their different customers? Well, it is simple. Costco is considered as a bulk retailer. And in fact, this model is pretty financially favorable for this kind of company. It is pretty simple how it works. Basically, Costco will purchase some bulk quantities of different products. And for those bulk quantities, they will receive some cheaper price. And at the same time, they will be able to sell those products for a higher price to their different customers. This is giving them a great competitive advantage compared to other of their different competitors that are obligated and forced to sell to a higher price. Another reason, obviously, they have a loyal fan base that is willing each and every single year to pay their different membership. And in fact, since they are just giving some great prices for a great quantities of different products to their different customers, they don't need to make any kind of advertisement or even to have any kind of ambience in their different shops. And add to that, to keep some great and some high employee retention, they are giving some great salary to their different employees. Basically, everyone is happy, employees are well paid, customers find great things at a cheaper price, and this business is pretty profitable. But of course, during a recession, people will be tighter in their different budgeting, meaning that obviously the different customers will have less money to inject in the overall economy. So it might tighten their profit margin a little bit, but since those customers will try to find obviously what is the essential stuff, but at the cheaper price possible, well, since Costco is offering that, well, they will most likely continue to go shop at this company. In fact, in 2021, with more than 111 million of card holders, well, they have been able to generate over $27 billion over the last year. And on that side as well, they have been able on the last 4 quarters to beat the predictions of the analysts for their different earnings. But now, let's see if this company is really undervalued in valuation terms. As you can see, Costco currently worth about $236 billion with a quite high price to earning ratio of about 40, meaning that with this indicator, this stock would be pretty much overvalued. On that same period, they have also been able to generate a massive $226 billion of revenue with a growth of 15% in their last quarterly revenue and a growth of about 12% in their last quarterly earnings. On their side as well, they currently have about as much cash as their current debt. We can also see that it is a stock that is not as much risky as the market with a beta of about 0.72 with a slight decrease of about 1.57% compared to about less 13% for the market since 1 year. Costco is also offering a slightly lower dividend compared to the 2 previous companies of about 0.68% per year. However, with a payout ratio of only about 25%, it means that this company could be eventually able to increase this dividend yield. Over the last 3 years, we can also see that their total revenue have been massively increasing, which has obviously led to a massive increase in their earnings before interest and taxes. But unfortunately, for their operating cash flow, we can see that they have been diminishing over the last 3 years, which has led to also a diminution in their free cash flow. As you've been able to see in this video, even if we are in times of high uncertainty on the markets, there are plenty of different stocks to look for in those kind of times, especially if you want to receive some high dividend income from those companies, but also if you want to protect yourself against the high inflation and against a potential recession. On your side, however, if you prefer to invest to have a little bit less risk, well, you can check out this video that will share with you what are the best ETFs for you. And for everyone that is new and that likes personal finance, make sure to join the North family by subscribing to the channel for only $0.0. And we'll see you soon. Peace!